I think if you actually see the merger market stats for this year, you'll find that tech has dwarfed any other sector in terms of investment. And that's where people are consistently wanting to invest. Up there also is that infrastructure, energy transition point, digital data, etc. So yeah, we're seeing the kind of people in terms of where they're placing their bets, placing it in those sectors. That's where the opportunity remains. There are differences, though, I think, between different countries. I think the main countries, the big five, so that's UK, France, Germany, and then to some extent Italy and Spain drive most of the volume. But also there are bargains still to be had in other countries who are not as big, particularly Eastern Europe, where perhaps prices are lower and potentially the gains are bigger. There's less competition in terms of fewer PE houses are looking to invest in those countries, but also it can be harder to invest there because the way that the countries operate, the laws are maybe less developed in some ways. But there are bargains to be had if you look carefully. You can get some really good champions. It was interesting to hear that actually Europe is still cheaper relatively than the US in terms of where to invest. Also interesting to hear actually that Europeans want to invest in the US given the current political instability a bit in the terms of what's happened with the tariff and trade wars. By building manufacturing capacity in the US, you can then take advantage of that market where at the moment, if you don't have that resource there, you're going to face obviously larger tariffs. I think also interesting to see that there's also anticipation of a restructuring wave and there's opportunities to be made from over-levered assets or where because of geopolitical reasons, some countries, some industries have fallen out of fashion or have been out of favor, and therefore there's an opportunity maybe to pick up a few bargains or to buy companies who are in distress, turn them around, rebuild them, maybe tech enable them and do things with them that they can't currently do under the current ownership. So I think, again, that's a great opportunity for private equity to find a good place to invest. The good thing about, I guess, most of Europe is if it's in the EU, on the face of it, there is a harmonious legislation in terms of the ability to invest on the same level playing field from a legal perspective. Similarly, in terms of the ability to work elsewhere around the European Union, transferability of skills, I think that makes it a very uniform, harmonious market. Having said that, tax laws are different, cultures are different, norms are different, languages are different, and that can make it more difficult to invest. Clearly, there's a lot of protectionism in today's environment, and there's been a lot of new foreign direct investment laws that have come in to protect local champions, which I guess is understandable in today's world. So there's less globalization, more nationalization, and obviously getting around these foreign direct investment rules is a key aspect of investing, particularly in key sectors like technology, defense, etc. So it's interesting to see how that will develop as well. So I mentioned earlier the big five, which is UK, France, Germany, Spain, and Italy, as being the biggest economies in Europe with the biggest peoples and actually having most of the kind of investment opportunity. So that's pretty by volume. I think other countries where you're seeing a lot of activity, Poland's got a big population, a lot of stuff happening in Poland, particularly on the tech front. Also seeing stuff in the Nordics, also the Benelux as well. There's quite a lot of investment there. So I think it's around looking for appropriate bargains in the markets you want to invest in. But as I say, proportionally, just because of size, you'll find the big five get most of it. Of those, the big three, Germany, France, UK, getting most of the investment generally. Well, on the risk side, clearly they get good legal counsel like ourselves, so hopefully to advise them how to deal with any legal risk. But also not just that, they obviously retain other professional advisors, whether it's tax, accounting, other consultancies, for example. So, PE are very good at having appropriate professional advisors to deal with and manage risk. From a local perspective, I think it's important that you develop and have locals on your team from the different markets who understand the norms, cultures, and sensitivities about doing business in different locations. And I think that gives you an edge, I think, versus if not having somebody from that market on your team. If you've got somebody who knows the inside track, who knows how things work, who can even bring deal opportunities, that's a better way of doing it, I think, than just fly in, fly out. But every house is different, every approach is different, some are more mature than others, and everyone has their own way of doing things. So that's how I would say I'm seeing investors manage risk, through the appropriate advisory community and also having appropriate local resource to deal with opportunities and pursue opportunities.